Welcome to week 2 of Bubbles, Panics, and Depression, a World History of Economic Crisis class. Week 2, make sure to look through everything on the website, okay, on Blackboard. This week we're going to talk about three different things. We're going to talk about money and banking, mercantilism and trade, and then some important economic theories. So be sure to read everything on the website. That'll help you out, okay? I'm going to summarize some stuff, but the real important stuff you need to look at on the website, okay, to look in some detail. Also, make sure that you do your assignment for the week. You need to do a discussion. You can access that by clicking on the discussion tab on Blackboard and then follow the instructions for week 2. Okay, so make sure you send me an email if you have any questions or any problems. Stay on task. Watch these videos because you get points for them now. Okay, so let's talk about the development of money and banking. When we talk about the development of money, what we're really talking about is something that's quite ancient. The development of coins is really crucial here because before coins were developed, trade was really done in terms of barter. uh, One thing was given for another thing. And of course, this is very cumbersome. You're going to give a camel for some horse hides, or something like that. You've got to haul these things across, some space in order to trade them. So uh, the development of coinage solves that problem. Now, coinage develops first in Greece in about 660 BCE. But it's also developing at about the same time in China. And so coinage becomes pretty common in the Middle East area and also in East Asia, especially in China. The Roman Empire uses coins, the Egyptian Empire uses coins, and a lot of the history of that time can actually be studied through the coins that have been uncovered. And so they're actually a good primary source for historians. But in that time, coinage facilitated trade because coins were small, they were easy to carry, and you could carry them long distances and then trade them or exchange them for goods. And if the coins were silver or gold, then the value of those were pretty constant. Okay, so the disadvantage of coinage is that coins had to be smelted. They had to be created in a smelter. The metal had to be heated up and then stamped. And that process allowed for what we call debasement. Now, what's debasement? Debasement is when a coin, let's say a silver coin like a florin, is people assume that the florin is 100% silver. And what happens over time is as these coins are traded, then some monarchs run short on money, and so instead of creating 100% silver coins like the florin, they actually put other metals in, other available metals like lead in with the coins, and what you have is the coin is actually not 100% silver. And as long as people don't know this, then that's fine. But the truth is, money changers figured this out very quickly, and so money changers would take a knife and scrape at the coin to make sure that the coin was 100% silver, and they could see these other metals in the coins, and so then the game is up. And what happens? The end result of this is the rise of inflation, because when you debase the coin, then that particular coin is worth less in real terms, in real economic terms. And the end result of that is that the price is going to go up. You're going to have to pay more of those particular coins for whatever product you're buying. That's inflation. Okay, so so coinage by about really by the time of Christ, coinage is very common, both in East Asia and in the Middle East, and then it spreads throughout Europe. So coinage is really key to economic development. Now let's talk for a moment about banking. The rise of banking really takes place in just a very small area within Europe. It really takes place in Italy, and mostly within the, I mean, Venice is important, but the really important place is Florence. You'll also see Niall Ferguson talking about this. And so uh, the banking system is developed by one family in Florence, one very powerful family, and then other families get in on it in Florence. But this family is the Medici family. They start out as wool traders, pardon me, and they develop some fairly sophisticated banking practices. Eventually, they have branches, 7 branches throughout Europe. They become the banker of choice for the Pope. So the Medici are actually very important to the development of banking. Now, the Medici are working under some limitations because they cannot charge interest. They're good Catholics, and the Catholic Church has outlawed interest. It's considered a sin. So they have to find another way to make the system work, essentially to develop wealth. And so the Medicis decide to put money out into the system through what are called bills of exchange. Now, a bill of exchange is is like a loan, only when the Medicis give you a loan, you get a piece of paper that says you have to pay this loan back and you have to pay an extra fee on top of it. It's not interest, but it's like a commission. It's like an extra fee, which is kind of equivalent to interest. Okay, so that's bills of exchange, which were used for private transactions and were pretty widely used by the Medici, and then became used by other banks. Now, the Medici also, because they had lots of money, they became very influential in borrowing money to city-states and to popes and to all kinds of what we would call public entities. And so the Medici develop a system of a piece of paper. So they'll give so much money to, they'll loan out so much money to, let's say, the city-state of Florence, and they did this. In return for which they get a piece of paper uh, in that is signed by the officials of the city-state, which says that after a certain amount of time, they get that amount of money back, plus, again, they get a fee. Since they cannot charge interest, then they just add in a set fee. What this is really the first public bond. It's an IOU, which is basically what a bond is. And so this is the first time that public bonds are actually offered. And so the Medici are important in that regard. The Medici are also important because they develop, uh, they charge to move money. They have all of these branches, and they move money throughout Europe via donkey and horse, and they charge people for it. They sometimes charge 20% of the amount that they're moving in order to move the money. This is enormously profitable for the Medici. Okay, so Florence develops this, it spreads to Venice and other parts of Europe, and so you have the beginnings of a banking system. Okay, now let's move on and talk a little bit about some other developments within Europe that change the economic system, and especially in terms of international trade. So, you all have heard of, well, maybe you haven't heard of, but here's the nursery rhyme. Columbus sailed the ocean blue in 1492. Okay, so 1492 is an important date because Columbus sails to the west. He explores the New World, and eventually he and others begin to open up new trade routes. So I'm not going to say much about Columbus and the other explorers, but let's talk about the trade routes. There are 3 main trade routes we need to talk about, and there are maps of the trade routes on Blackboard that you can look at. Let's talk about the transatlantic trade route, which began to develop in the 1500s and really became very important in the 1600s. That trade route was a trade of goods from Europe, like firearms and blankets and other things, to Africa. And then in Africa, these goods would be traded for slaves, which were brought to the Caribbean and other parts of the New World. And those slaves would be exchanged or sold. And then these traders would pick up goods from the New World, like sugar plantations, or rice or tobacco. All of these things were traded, and then that stuff is lumber, that stuff is fish, that stuff is brought back to Europe then. So it's this triangular trade between Europe, Africa, and the New World. Okay, trade route number two, which is the East Indies. Now, this is a long range trade route, and Niall Ferguson in another video talks about how the Dutch really developed this long range trade route. The Portuguese started it. They didn't have the money or the ship capacity to maintain it. The Dutch did. The Dutch are really kind of the UPS of the 16 and 1700s. And so the Dutch become the traders par excellence. They develop trade forts in what we call the East Indies, which is today Indonesia, Singapore, Malaysia, Sri Lanka, India, and they're trading goods. They're sending their ships out, and sometimes they don't send European goods at all, but they go with coins, with money, and they buy goods like spices, cloves, cinnamon, other kinds of spices, and they bring those spices back. And those spices are extremely valuable within Europe, and so they make a lot of money. For instance, one trip by the Dutch East India Company netted them a profit of 400%. The average take over a century for the Dutch East India Company was about 16 to 20%. That's really good money. That's an annual, that's annual increase in your wealth. So that's pretty terrific. Okay, so the third, so that worked very well for the Dutch, and later on the British took over parts of that. But that's an important trade route. That's a very risky trade route because it's a long route. You have to go down the west coast of Africa, around the Horn of Africa, and then into the Indian Ocean, and do your trading that way. Okay, so there's one more. That's the Pacific route, and this is a route that's established by the Spanish when they conquer Latin America in the New World. Then the Spanish set up a trade route between Acapulco, which is in Mexico, part of Spain, part of New Spain. Uh, Ships go from Acapulco to Manila, which is in the Philippines, which is also a Spanish colony. And then those ships head up to China. And so it's another triangular trade route which goes between Acapulco, Manila, and China. They're shipping silver from Acapulco. The silver mines in Mexico are far and away the most prolific. The Potosi mine is the largest silver mine in the world in the 15 and 1600s. And so the goods travel that way. The silver goes to Manila, it goes up to China, and then China sends goods back like porcelain, silks, and tea back to Acapulco, and then it's transshipped across Mexico and then shipped off to Europe. Okay, so those are some of the basic parameters that we're talking about in terms of the early modern economy. There's one other thing, and that's important, and that's the rise of the concept, the economic approach of what we call mercantilism. Now, mercantilism was an approach which developed out of this new trade that the Europeans engaged in the New World and in these other places, the trade routes I just talked about. And mercantilism is actually a concept of national wealth and national power. The Europeans at this point believed that the more gold they could develop in their treasury and silver, the more powerful they would be. So gold and silver become absolute goods in Europe. And so the Europeans pursue the gold and silver relentlessly. This is what they're doing in Mexico and in Latin America. And they believe that the more of that they can get, the more powerful and wealthy they will become. They can fund armies, they can defeat their enemies, and they can win in the competition with other European powers. Now, the other part of this is if you're going to get more gold and silver, you have to export goods and import the gold and the silver. Okay, and that's an important part of mercantilism. And so mercantilism becomes powerful between about 1500, the time of Columbus, and 1800 is really when it's winding down. It's a flawed economic theory. We now know that a balance of trade is better than all exports and no imports. And we also understand that gold is actually a commodity that can be traded like any other commodity. There's no necessary intrinsic value of gold. So, but that's early modern mercantilism. It's quite important. Okay, let me stop there and